Hello, everybody. This is the accounting professor, Bennett Tchaikovsky, and welcome to my intermediate accounting income taxes part one, temporary differences. My disclaimer and copyright notice, the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I'll make reference to publicly available information that is the copyright of other parties. I do not claim anything into the copyright of those parties whatsoever. So let's talk a little bit about temporary differences. And this is different than what we were looking at earlier, permanent differences or items that will never be taxed. With temporary differences, this can arise out of a lot of different types of things, mainly with things like depreciation expense, meaning that we're going to have a difference between how we're computing it for our books and how we are going through and computing it for tax purposes. And so when we have a temporary difference, this will result in either a deferred tax asset or a deferred tax liability. So let's go ahead and actually just kind of jump right into it and kind of take a look. These are different slides about essentially like what kind of happens with regards to temporary differences. But I think really what the better way to kind of approach this is to just essentially let's go through and look at a question. So first question we're going to go ahead and look at is this question 2. Which is we had River Corporation began operations in year 1 and reported $300,000 of pre-tax financial income for the year. Okay. The tax depreciation exceeded its book depreciation by $40,000. River's tax rate for year 1 and all years thereafter is 25%. In year 2, River reported $400,000 of pre-tax financial income. In year 2, book depreciation exceeded tax depreciation by $40,000 from the year 1 adjustment. This is a reversal of the temporary difference between GAAP and tax accounting. So again, we're keeping this very simple just so we can kind of go through and see how this actually goes through and works. So let's go ahead and see. We've got year 1, we've got year 2. Make this a little bit bigger. So over here for year 1, we have pre-tax financial statement income of $300,000. And we're also being told right over here that we basically have that my book depreciation, that my tax depreciation exceeded its book depreciation by $40,000. So tax exceeds book by $40,000. Now, what's going to happen is that, well, what does this mean? It basically means that for income tax purposes, if my tax depreciation is greater than my book depreciation, then the amount I'm actually going to be taxed on is going to be $260,000. And what we're going to go ahead and do, this is essentially, we'll call this our taxable income. And so what exactly is going to happen in year 1? Well, the first thing we're going to go through and look at is, maybe let's do this one first. Let's take a look at income taxes payable. So for my income taxes payable, what am I going to have to actually go through and pay taxes on? Well, that is simply going to be $260,000 at 25%. Okay. Now, at the same time, we also are going to have our income tax expense. For our income tax expense, this is going to be our $300,000 times 25%, or $75,000. And now, our total debits do not equal our total credits. Now, why is this? It's because I'm getting a break this year from my tax depreciation is exceeding my book depreciation, but ultimately I will have to pay Uncle Sam. So what we're going to call this is going to be a deferred tax liability. Okay, so this deferred tax liability is going to essentially be the 40,000 times 25%. Okay, so that's how we're going through. And this is going to be year one to record income tax expense. Now, one of the things I want to show you is with regards to Meta platforms. And I always like using Meta as well as some of these other companies. But if I look at Meta platforms, and I will provide you the link below, if I look at Meta platforms, you're going to see a provision for income taxes of about $25 billion right now. Is this money going to be payable now? Well, let's go through and find out. If I do a search here on my SEC document, just for deferred taxes, and here we go. So on note 14, and you're going to see this in the way that the way this kind of works is that you can, on the face of the income statement, essentially say, well, our income tax expense, what's the current portion and what is the deferred portion? You can essentially say it like that because really when we look at income tax expense, right, if I were to put this on the financial statement, could say income tax expense, current income tax expense, deferred. And I would kind of say that, well, my current income tax expense is 65 and my deferred is 10,000. But instead of that, we're just basically coming out and saying it's 75. But in the footnotes to the financial statements, what we would want to go through and do and disclose, and this is, by the way, this is going to be called the provision for income taxes. Okay, that's fine right over here. But if I go ahead and look over here, what you'll notice is that the provision for income taxes, this was on the face of the financial statement. This is 25,474. But this is broken down in the footnotes to be right over here. So you look at this and you basically say, well, the total current tax expense is 6.7 billion. My deferred tax expense is 18 billion. So when we look at this, what we kind of say to ourselves is, okay, part of this is deferred, part of this is current, and we're going to show this in the footnotes to the financial statements. In fact, most of the time when I've seen this being put on income statements, I have never seen it broken out like this, but it has to go into the financial statement footnotes. Okay. So that's what we're kind of looking at over here. So we're going to have in our financial statement footnotes, essentially what is the current portion and then what is the deferred portion. Okay. We now get over here to year two. And so again, we started here with 300,000 of income. We said that our tax depreciation exceeded our book depreciation by 40,000. And now we're getting over here to that gave us our taxable income, which is our income taxes payable, meaning what do we have to pay currently? The remaining amount is our deferred tax liability. Okay. So now what we do in year two is we're going to kind of say to ourselves, like, okay, what happens over here in year two? Well, my pre-tax financial income for year two is going to be $400,000. However, my book depreciation over here exceeded my tax depreciation by $40,000, meaning I now have to go through and pay this. So what that means is that, well, if the book is higher and it's not allowed for tax, then over here, my total taxable income is going to be 440,000. So when we get to this point over here, we're kind of need to go through and do the same exercise. Well, my income tax expense is going to be over here at 400. Well, we can actually do it like this. We'll say 400,000 times 0.25. Remember, the income tax expense is going to be based on my financial statement income. but my income taxes payable, this is going to be over here. This is going to be at 440,000 or 440,000 times 25%. Okay, now we need something over here to go through and to balance. What do we need to go through and to balance? Well, we need 10,000. And this is where we're going to go through and reverse our deferred tax liability. And this is going to be for year 2. Okay, so this is kind of what's happening here, as we can kind of see this is going through and reversing. The income tax expense is right over here. And now we're kind of basically, we accrued for this amount related to the depreciation expense in the future year. Now we're paying it, so we're going to go through and relieve the liability. So in my footnotes to my financial statements, and just give me one moment. Okay. And now, so coming over here, when we go through and look at this, we're now going to basically say, okay, my income tax expense current, and this is really going to be based on my income taxes payable, or this is going to be the 110,000. And then I have income tax expense deferred minus 10,000, and this is going to get me to my total income tax expense. Okay. So right over here, when we're looking at this, is we're going to be reconciling to that financial statement number. And the income tax expense current is really kind of another way here, at least saying, maybe not to say, it's a better word to kind of say this, is to kind of go through and to say payable, but we're kind of saying current, federal, state. So basically, why don't we just go ahead and basically label this like we kind of see it in the footnotes to the financial statements. Over here, we'll just call this current, federal, current or deferred, federal, current, federal, deferred, federal, and that needs to equal to my total income tax expense. So this is kind of how we're kind of going through and doing it. Again, as you can kind of go through and see, these are temporary differences that are going to go through and reverse themselves out. So this is kind of what we have over here when it comes to deferred, basically an example of a deferred tax liability. So let's just kind of go through and talk a little bit now that we've done an example. Let's kind of go through and take a look at this over here. So again, the depreciation that we just looked at was a temporary difference, right? Meaning that unlike the permanent differences we looked at in the previous video, right? So unlike this, which is, hey, this will never be taxed or this will never be able to be deducted, those were immediately going through and hitting us. Whereas right over here, this is a little bit different. This is a timing difference or a temporary difference. And so accordingly, this is going to essentially go through and create a deferred tax liability or a deferred tax asset. Now, we've only looked at deferred tax assets or liabilities so far, but let's go through and kind of take a look at this. So again, temporary differences will show up as a deferred tax assets. You're always going to be showing deferred tax liabilities. And what we're going to look at momentarily is with deferred tax assets can be a little bit more tricky. Why are deferred tax assets a little bit more tricky? Because, well, as any assets, auditors have no problem recognizing liabilities. When it comes to deferred tax assets, that's when we have to ask ourselves is, well, will we ever be able to go through and to utilize this deferred tax asset? So when we look at this here in terms of coming into, and let's just kind of jump into let's go back over here to Meta. And what's interesting is that I just got an email this morning from UWorld CPA Review talking about that Reg and TCP are now going to be implementing, or they're going to be discussing the one big beautiful bill. So right over here, this is as a result of the implementation of the One Big Beautiful Bill Act enacted in July of 2025, we expect to incur corporate alternative minimum tax beginning in 2025. We recorded a $15.93 billion charge in the third quarter of 2025, of which 14 billion was a valuation allowance against our U.S. federal deferred tax assets as of the enactment date. So when we look at this, when we talk about deferred tax assets, that's when we have to kind of go through and say, like, okay, if we have a deferred tax asset and we don't expect to realize it, we're therefore going to have to go through and take essentially we'll have to go through and take a valuation allowance. So just kind of looking at here, just before we get to another example, looking at different temporary differences, what you'll kind of go through and see is that, financial statement income first, tax return income later, like say installment sales. Maybe for this purpose is that if we're recording an installment sale, that for tax purposes, we don't recognize it until the very end, meaning it's going to defer. Basically, it's going to be a future tax liability. Taxable income for first might be something along the lines of someone is prepaying rent. So if someone's prepaying rent, we would call that deferred rent. But however, for tax purposes, they may not allow us to go through and to do that. Other types of temporary differences, and we'll see this later, is when we have like bad debt expense or warranty expenses, meaning that we're taking a deduction, we're estimating what our warranty liability will be. We're going to record warranty expense now because it's going to align with the sale. However, for tax purposes, as they may say to us, like, no, that's not going to work. You're going to have to go through and show that later. And then here we've got over here what we just kind of saw with the depreciation expense, more temporary differences. Again, this is just more different examples, but let's go through now and take a look at an example where we have deferred tax assets. Now, what's really important on this one here is that deferred tax assets will arise when the amount of the taxes paid in the current period exceed the amount of the income tax expense in the future period. These are going to be anticipated future benefits, basically arising from different situations. And this is the key component. If more than likely, meaning 50% or greater, that part or all of the deferred tax asset will not be realized, then you have to create a valuation account, right? So the valuation account is going to take down our deferred tax asset, much like an allowance for doubtful accounts. And then that's how we're going to go through and take a look at this. So again, when does it reverse is when the IRS allows the deduction in the future period. What is a valuation allowance? We're going to create a valuation allowance. We're not going to credit the deferred tax asset directly. Rather, we're going to use a valuation allowance. But we also have to make sure we're keeping enough evidence when we go through and look at this. So now let's go ahead and take a look at this next example here, which is YYZ had pre-tax accounting income of $600,000 and taxable income of $900,000 for the year ended 12/31/28. And then we have these different temporary differences coming through, and just give me one moment. Okay. So YYZ had pre-tax accounting income for 2028 of $600,000. Okay. So coming over here, of 900,000. So basically it said its taxable income was 900,000. Okay, so why did this happen? Like, what was the cause of this difference? Well, when they were recording warranty expense, because remember, when you do warranty expense, you're going to basically debit warranty expense, and then you're going to basically credit warranty liability. You might have a current versus a non-current portion, but this over here is going to be 300,000, and this is going to be 300,000. Now, what the IRS kind of says is like, you can't have this deduction. Why? Because you actually haven't paid it yet. So what this is going to be is this going to be the warranty expense add back, and this is going to be 300,000. Okay. So now when it comes to our going through and basically figuring out like, all right, how do we go through and do this? Explain why taxable income exceeds pre-tax financial income. Well, the warranty liability is an accrual. We don't get to deduct it unless we've paid those warranty costs. And that is why taxable income is exceeding pre-tax financial income. Compute income taxes payable as of 12/31/28. And we're just going to go ahead and basically do these journal entries all here at once. So over here, we're going to essentially have income tax expense. And then we're going to have income taxes payable. Okay, so for our income taxes payable, this is going to be our taxable income times 22%. Okay, so our income tax expense is going to be right over here. It's going to be our pre-tax accounting income times 22%. Okay, now what's the difference here? Well, I'm kind of prepaying for this warranty part right over here. So this is going to be a deferred tax asset. Okay, so this is as of 2028. 2028. And so record income tax expense. Now, like on the previous example, what I need to go through and do, right? And again, this is my deferred tax asset is going to be the difference between these two right here, or 66,000. Now, where are we getting the 66,000 from? The 66,000, just give me a moment. So the deferred tax asset, or the difference between these two, this is also right over here. This is really the 300,000 times the 22%. Remember, we don't say the deferred tax asset. We're just going to leave that as is. We're not going to say it's current versus non-current, but that's how we're going to go through and look at this. So we've got this part over here, but when it comes to disclosure, right, in the financial statements footnotes, very much like our friends at Meta Platforms, what we're going to go ahead and do is basically say, okay, well, we have our income tax expense. This is going to basically be based on the income taxes payable or income taxes current, income taxes deferred. This is going to be 66,000. So our provision for income taxes is going to be the difference between these two. Okay, now you also can, if you wanted to say on income tax expense, you could also break this up on the face of it. Again, my preference would be to basically put this into the footnotes of the financial statements. Okay, now what's really important here is that when we have this deferred tax asset, right, this is going on our balance sheet. We have to be able to say we're going to be able to utilize this asset in the future. And there's nothing here that's giving us any information contrary to anything contrary to that. So let's go through now and take a look at 2029. So for 2029, we're assuming that the pre-tax income was 500,000. But now what's happening is we actually went through and we basically paid 100,000 of the warranty expenses. So we're now going to get a deduction for those warranty costs, right? So here we weren't allowed to deduct it, but now we're allowed to deduct it because we actually paid for it. So my taxable income in 2029 is going to be 400,000. So let's go ahead and take a look at how this would kind of play out. So we're going to have income tax expense. This is going to be my pre-tax accounting income times 22%. We're going to have income taxes payable. This is going to be 400,000 times 25%. It's going to be times 22%. Okay. Now we say to ourselves, well, what's happening here? Well, we have over here to balance this equation. At the end of 2028, we had a deferred tax asset, and my deferred tax asset was 66,000. And what exactly is happening here? So this is 12, we'll call this 1/1/29. This was the ending balance of 12/31/28. Well, now I'm actually being able to use part of this because I'm actually settling out my liability. So here I'm going to have a deferred tax asset, or I'm going to be decreasing this by 22,000, or the 100,000. Okay. So this is also going to be record income tax expense. All right. So now my deferred tax asset, as I just went through and used this during 2029, so my ending balance and my deferred tax asset on my balance sheet is going to be 44,000, or these two here that I'm supposedly going to be using in the future. Now, the key is, can I use this in the future? And at this point in time, the problem is not giving me any kind of indication that I cannot do that. So let's go through now. We've done these two over here, but now we need to do the footnotes to the financial statements. So over here, we're going to have our income tax expense, or our income taxes current. This is going to be based on the income taxes payable. And then we're going to have our income taxes deferred. And this is going to be an increase over here by 22,000, which is going to get me to my provision for income taxes, which is on my expense item on my income statement of 110,000. Okay. So again, and this is the process we would be going through year after year in terms of going through and doing it. Remember, the key is here with this deferred tax asset as of 12/31/29. This has to basically be shown over here as a deferred. It's basically, I need to be able to make sure that I can actually recover it. Also, on the footnotes of the financial statements, your income taxes current are going to be based on income taxes payable. Your income taxes deferred will either go one of two ways, but then this is going to be my provision for income taxes, also known as income tax expense, will be right over here. Okay. Now, let's take a look at the next example. And this is the one that's kind of crazy. Just give me a moment. Now, we want to assume the same facts as in example 3, except that management believes that as of 12/31/29, the likelihood of utilizing the deferred tax assets for 2030 and 2031 are less than 50%. Okay, so this is a separate situation from this one right over here. Well, let's go ahead and take a look at this. So our deferred tax asset is right now sitting at 44,000. And what we're now saying is that, hey, we're not going to be able to utilize this deferred tax asset. So what do? What we're going to go ahead and do is we're going to have a valuation allowance basically to reduce the deferred tax asset. And if we're not going to be able to utilize this, what we want to go ahead and do is we want to say, all right, so if we want to bring this on our balance sheet, if we are looking to bring this balance down over here, so we have a DTA of 44,000 less valuation allowance, right? This is a contra-asset account. We want this to be 44,000. We want this to go to 0. So what I'm going to need to go through and do is to basically make a reporting over here for 44,000. Okay. So I'm going to basically credit the valuation allowance to reduce the DTA to 0 of 44,000. And now I need a debit for 44,000. Okay. So what account do I want to go through and debit? If I go back in time and look at really why was this deferred tax asset created? Well, it was because my income tax is payable, where I was basically not recognizing the full amount of the income tax expense. So what I'm going to go ahead and do here is just record income tax expense when I'm going through and recording this valuation. So when I have to basically take this valuation and bring it back down to 0, this is what I would be going through and doing to record valuation allowance to reduce the deferred tax asset. Remember, this is going to be a hypersensitive item for auditors. Why? Because if you have an asset sitting on the books, they're going to be scrutinizing it because if that asset is not realizable, it's going to create problems. So again, when you see what Meta did, it's basically they said, hey man, we went over here and we took a valuation allowance against our US federal deferred tax asset as of the enactment date because we don't know, we're not going to be able to go through and to utilize it. So really, really important when we're going through and looking at this is to kind of go through and to keep that in mind. So again, this is obviously this is a little bit of a longer video. I thank you though for joining me here today. Thank you for watching and don't forget to like and subscribe and I look forward to seeing you on the next video. Have a great day.